Hello, I'm Doreen Strothman, Underwriting Claims Counsel for Security Title Guarantee Corporation of Baltimore. The start date for FinCEN's new residential real estate reporting requirement. It's coming up fast. To help you prepare, we're offering presentations or videos covering different aspects of the reporting process. In this first presentation, we're addressing what is a covered or reportable transfer. This FinCEN reporting process is different from the geographic targeting orders reporting process currently in place. This process is not limited to certain counties or states. It applies nationwide, including all 50 states, the District of Columbia, Puerto Rico, overseas U.S. territories, and Indian lands. Importantly, there is no minimum purchase price for reporting. Each transaction must be evaluated to determine if it is a reportable transfer. A reportable transfer is defined as a non-finance transfer to a transferee entity or transferee trust of an ownership interest in residential real property. We will now look at the three parts of that definition. First, for this purpose, residential real estate includes property with 1 to 4 family residential structures, vacant land intended for 1 to 4 family residential construction, shares in a cooperative housing corporation, or a mixed-use property that includes 1 to 4 residential units. Thus, if the property is a building with retail, office, or warehouse uses, but that also includes 1 to 4 residential units, it is considered residential real estate regardless of its zoning classification. Second, you must determine if it is a non-finance transfer. A non-finance transfer is one that does not include an extension of credit to all transferees secured by the residential property, with a secured mortgage or lien, and extended by a financial institution subject to anti-money laundering programs. Banks and credit unions are subject to anti-money laundering programs, but you may need to inquire about other types of financing entities to determine if they are subject to anti-money laundering programs. In short, if a transaction does not include a mortgage loan from a regulated lender, it may be reportable. Third, look at the transferee, the new owner. If the transferee is an entity or trust, it is generally a reportable transfer unless it qualifies for an exemption. Entities include corporations, LLCs, partnerships, or other similar business entities. A transferee trust is one created when a grantor places assets under the control of a trustee for beneficiaries. Finally, even if a transfer or transaction meets the definition of a reportable transfer, you may not need to report it if it falls under one of the exemptions. There are 3 types of exemptions: entity exemptions, trust exemptions, and transfer exemptions. Here are some examples of each of those exemptions. Entity exemptions include, but are not limited to, insurance companies, state-licensed insurance producers, entities required to file security reports, banks and credit unions, and government entities. Trust exemptions include securities reporting issuers, statutory trusts, estate planning trusts with no consideration, where the seller or spouse is also the grantor. Transaction exemptions include grants, transfers, or revocations of an easement, transfers resulting from death, divorce, or bankruptcy, court-supervised transfers, transfers involving a 1031 deferred exchange, and transfers for which there is no reporting person. If no exemption applies, then you have a reportable transfer or transaction. That summarizes the standards for determining whether a transaction is covered or reportable. Upcoming presentations will explain who is the reporting person, what information must be reported, and how to complete the online FinCEN report. These resources will help you prepare to comply with FinCEN's required reporting for residential real estate transactions. Good luck with the new process.